discuss how to compute annual value of the property. Okay, how to compute annual value, because in income from house property already we discussed that the rent which is received by person, rent which is received, that is taxable under the income from house property. But how to compute that rent? Okay, for that purpose we have to compute annual value of the property. So how to compute annual value of the property is very crucial aspect. Okay, so computation of income from house property. Okay, computation of income from house property. How to compute income from house property? See, though this chapter is theoretical chapter for you, okay, but until and unless you studied about how to compute the house income from house property, you never write down the theory on this chapter. That's why we are going to discuss how to compute income from house property. So first thing is that we have to calculate municipal value of the property. Municipal value, B point, fair rent, C, standard rent, reasonable expected rent, A or B, whichever it is higher, subject to maximum of C. So basically this is the specimen how to compute gross annual value or annual value of the property. How to compute annual value of the property. Okay. So municipal value. Now what is meant by municipal value of the property? Municipal value means value determined by municipal authority. It is called as municipal value. It is given in your problem, municipal value. Okay, you never want to compute any municipal value, it is given there in the problem. Okay, but what is meant by municipal value? Municipal value means value determined by municipal authority. Okay, second is fair rent. What is meant by fair rent? Fair rent means rent received by similar property in the similar area. In the similar area is called as fair rent. And third one is standard rent. What is meant by standard rent? Standard rent means rent given in the Rent Control Act. It is called as standard rent. On the basis of these three, we have to compute reasonable expected rent. This is the specimen. Okay, and you have to follow this specimen while computing income from house property. So first, you have to take municipal value. It is there given in your problem. Second, fair rent. But you must have to know about the meaning of these all terms. What is meant by municipal value? Municipal value means value determined by municipal authority. Okay. Fair rent means what? Rent received by similar property in similar locality, because area wise there is a different rent. That's why similar property received rent in the similar area, that rent is taken here as a fair rent. And standard rent. Standard rent means rent defined under Rent Control Act. Okay, it is there in your notes also, the meaning of all these terms. Okay, so reasonable expected rent. On the basis of these three values, we have to compute reasonable expected rent. Now, what is meant by reasonable expected rent? A or B, whichever is higher, subject to maximum of C. Okay, means you can learn also municipal value or fair rent. whichever is higher up to the extent of standard rent. A or B, municipal value or fair rent, whichever is higher, subject to maximum of C, that is standard rent. Okay, just like suppose municipal value of the property is 100 rupees. Okay, fair rent is 120 rupees and standard rent is 110 rupees. Okay, so on the basis of these three data, we have to compute reasonable expected rent. Now, what is reasonable expected rent? Municipal value or fair rent, whichever is higher. Fair rent is higher, that is 120. Up to the extent of standard rent, it means that this value is not more than standard rent. Up to the extent of standard rent. So, what is standard rent? 110. So, your reasonable expected rent is 110 rupees. Okay, if municipal value is 100 rupees, okay, fair rent is 90 rupees and standard rent is 80 rupees. Standard rent is 80 rupees. Now, municipal value or fair rent, whichever is higher, municipal value is the highest. But this value will not greater than standard rent up to the extent of standard rent. Okay, standard rent is 80, so your reasonable expected rent is 80. Third condition, if municipal value is 100, fair rent is 130 and standard rent is 150. Okay, now municipal value is 100, fair rent is 130. So municipal value or fair rent, whichever is higher, fair rent is higher, 130. Up to the extent of standard rent is 150. So we can take down reasonable expected rent as of 130. Okay, but we never take any amount which is more than standard. You can take down the less amount, okay, but we cannot take any more amount than standard rent. Okay, so municipal value or fair rent, okay, whichever is higher up to the extent of standard rent. So we get reasonable expected rent. Okay, now next is actual rent. Actual rent. Actual rent means what? Annual rent minus unrealized rent is the actual rent. Actual rent means actual rent received by that person, okay, or by the assessee. Actual rent received by the assessee. So annual rent means the rent of entire year is the annual rent. Okay, suppose any person pays rupees 12,000 per month. So annual rent is what? 12,000 per month into 12 months. Okay, so what it is? 1,44,000. It is your annual rent. Okay, minus unrealized rent. Okay, annual rent means not actually rent received. Okay, annual rent means the rent of entire year. Okay, so rent per month is 12,000. Okay, into 12 months, so we get annual rent 1,44,000. But the tenant to whom the property is given on rent, that tenant is not paying rent for 2 months. Okay, he is not paying rent from 2 months. Okay, which we call as unrealized rent. Unrealized. Till we not received that rent, that is called as unrealized rent. Okay, so 12,000 per month is the rent into 2 months. So it is 24,000. Okay, is that clear? What is meant by actual rent? Actual rent means actual rent received by the assessors. Okay. Now, on the basis of this, we have to compute RER or AR, whichever is more. Okay, reasonable expected rent or actual rent, whichever is more. Okay, so reasonable expected rent already compute. Actual rent, how to compute actual rent? Annual rent per month is given. On the basis of that data, we have to calculate annual rent minus if there is any unrealized rent. Not necessarily that unrealized rent is in every case. If there is any unrealized rent, in that situation we have to minus that rent from annual rent so that we get actual rent. Now higher of RER or AR. Okay. Less. This is the pro forma, less vacancy loss if any. Okay, vacancy loss means what? If the property is vacant for some period, okay, because already we take annual rent. Okay, already we compute annual rent. But maybe it is possible that property is vacant for some 1 month, 2 month, 3 month. Okay, so we have to compute vacancy loss also. Okay, just like this. Okay, if this property is vacant for 3 months. Okay, this property is vacant for 3 months. Now rent per month is 12,000. Okay, into 3 months. So 36,000 is your vacancy loss. Okay, so when we compute RER or AR, whichever is more or whichever is higher, from that we have to deduct vacancy loss if any. Okay, so that we get gross annual value. Gross annual value. Okay, now we are going to towards annual value of the property. Okay, so what are the steps given? Firstly, municipal value, fair rent, standard rent. On the basis of this data, we have to compute reasonable expected rent. What is the condition for RER? A or B, municipal value or fair rent, whichever is higher, up to the extent of standard rent. Okay, now actual rent. Actual rent, how to compute actual rent? Annual rent minus unrealized rent. Now next condition is what? RER or AR, whichever is higher. Okay, out of this amount we have to deduct vacancy loss if any is there. Okay, now we can go for gross annual value. The amount which we get is called as gross annual value. Okay, now from this gross annual value, less municipal taxes paid by the owner during previous year. Okay, we get gross annual value, but we have to compute net annual value, and for the purpose of computing net annual value we have to deduct municipal taxes. But the basic condition is that municipal taxes paid. Very important thing is that if municipal taxes are payable, in that situation we cannot take deduction of municipal taxes. So municipal taxes must be paid by the assessee, and who paid the municipal taxes? Owner of the property. Owner of the property. If owner paid municipal taxes, in that situation owner can take the deduction of these municipal taxes from gross annual value. Because in some cases, suppose owner says tenant that go there and you pay the tax to municipality, and tenant pays municipal taxes, in that situation owner will not take any deduction of municipal taxes from gross annual value. Okay, that's why it is clearly stated that municipal taxes paid, okay, not payable, paid by the owner, okay, not by the tenant during previous year. Okay, during previous year. Okay, so previous year any municipal tax, in previous year any municipal tax paid by the owner, okay, so he can take the deduction of that municipal taxes from gross annual value, so that when he deduct municipal taxes, then we get net annual value. Net annual value. Okay. And when we get net annual value, out of this net annual value, some deductions are there given in Income Tax Act. Okay. Less standard deduction at the rate of 30%. Directly standard deduction is given at the rate of 30%. Now why this standard deduction is given by Income Tax Authority or by government? Because when we let out property, okay, when we let out property to tenant, maybe there are some expenses incurred on that property for the purpose of repairing. Okay, so we see in entire format, anywhere we never deduct any amount which we spent on the maintenance of that property. That's why government is given directly standard deduction. Okay, there is no need to maintain any books of account for your house property. Okay, if you spend some amount on the maintenance of that property, for that purpose you never want to maintain any bills or you never want to maintain any books of accounts, directly take standard deduction at the rate of 30%, and this standard deduction is taken on the net annual value of the property. Okay, and second deduction is that if less interest on loan, if the assessee is taken any housing loan, and on that housing loan, now when we take any loan and when we repay the amount of that loan, in that repayment amount principal amount is also included and interest amount is also included. Okay, so this interest on housing loan is taken as a deduction under income from house property. Okay, so interest on loan, okay, when we take the deduction of interest on loan, then we get income from house property. Income from house property. This is the specimen how to compute income from house property. Now, why I explain all these terms to you? Because though this chapter is theory chapter in your syllabus, but if there is a question how to compute income from house property, in that situation you can explain each and every term in your answer, and after that if we prepare this specimen, okay, so your answer is more better than other people. Okay, that's why by this way we can compute income from house property. Okay, so just we repeat once again and then we stop. Okay, municipal value or fair rate and standard rate. Okay, now on the basis of this data we compute reasonable expected rate. What is the condition for reasonable expected rate? Municipal value or fair rate, whichever is more, yes, higher up to the extent of standard rate, and subject to the maximum of C, standard rate. Okay, now actual rate. How to compute actual rate? Annual rate minus unrealized rate. Annual rate means rent received for entire year minus if there is any unrealized rate. Okay, so we have to deduct unrealized rate. Now RER, reasonable expected rate or annual rate, whichever is higher. Okay, from that amount we have to deduct vacancy loss if property is vacant for some period. Okay, so the loss of that period is also deducted for the purpose of computing income. Okay, we have to deduct this loss, and now we get gross annual value of the property. Now from this gross annual value we deduct municipal taxes. Okay, we paid municipal taxes to government. Okay, so municipal taxes paid by the owner during previous year. What is important? Municipal taxes must be paid to by whom? By the owner of the property, and during previous year. This previous year is also very important aspect. Okay, and when we deduct municipal taxes from the gross annual value, so that we get net annual value of the property. From this net annual value we deduct standard deduction at the rate of 30%. Why we take standard deduction? Already I explained. Many times it is possible that we must have to spend some amount on the repairs and maintenance of the property. Okay, and it is not possible every time that we have to maintain books of account. Okay, not each and every person maintains books of account. That's why government gives directly standard deduction. Okay, directly you can take 30% amount as a standard deduction on your net annual value. Okay, after that if any housing loan is taken by the assessee, on the payment of installment of that housing loan, when we paid interest on that loan, for the interest we can also take any deduction, and when we deduct standard deduction and interest on loan from the net annual value, so we get income from house property. Okay, So is it clear?
Yes,
Yes,
sir.
sir.
Okay. Thank you.